you. Thank you so much to Jim and to the Aspen Ideas Festival for this conversation. It's one I've been excited about ever since we first discussed this idea, because it really does feel like there's this kind of once-in-a-generation change that's afoot right now with regard to CEOs not necessarily needing to care only about their top and bottom lines. They have to care about their societal impact, their stakeholder impact, symbiosis with all sorts of individuals that previously may not have been a priority. How do you think that the success of today's business is changing, how we define success for today's business?
Leslie, I'm an investor, and investing is actually observing. So as I observe what's happening in the business of business, beyond the day-to-day change, occasionally there's change in the ethos of what we do. I'd start in the 80s when there was a rise of management science, think Jack Welch and quarterly earnings progressions. Then in the 90s, there was the rise of globalism, global supply chain, something we're unwinding today. In 2000, after we had been taught to measure everything, suddenly we had to move faster and break things, the rise of entrepreneurship. And right now, there's something going on. We haven't quite named it. It's sometimes called stakeholder capitalism. It might be referred to as ESG. But there is a change in the ethos of what's expected of business. You don't have to just feel it in the air. You can see it in what you're watching. Take, for example, net zero pledges. 1,600 companies to date, we were counting the other day, 1,600 companies have made net zero pledges. This is a 30-year commitment with no price tag to change how they do business. We counted 100 top companies in the US, 94 of them made statements on Black Lives Matter or George Floyd. We went back into the 60s. We couldn't find a single corporate statement on Martin Luther King's assassination.
Fascinating.
There's this change in what's expected. If you look at the Edelman Trust Index, I don't know if you follow this, all of you should look it up. It's kind of what do people trust? The most trusted part of the economy today is not NGOs, it's not the media, sorry.
Oh, darn.
It is actually business, which is number one in terms of trust. Trust everywhere is down, but business is held steady.
Business is the most trusted.
And in fact, if you ask people where they get their truth from, ahead of the media, ahead of government is business.
Why is
now, it's
that?
Not,
I'm honestly shocked to hear that.
Ask Mr. Edelman. But I think in some ways we're looking for smaller communities, and workers, people at companies are turning to their companies and asking more of them. Maybe it's the generation that's coming on, but it's reflected in the activities and the expectations of business. And for us as investors, that plays out with two ideas, ESG and impact investing, both of which are around this broader question of how would you ignite private capital to the world's problems.
So let's take a step back and define those two terms, because I think there are a lot of definitions, and as you mentioned earlier, there isn't necessarily a term to describe this sentiment shift that's happening right now. So how do we best understand ESG as it pertains to impact investing? Stakeholder capitalism is another term that we hear thrown out time and time again. So how do all these things kind of interplay with each other? Why are they becoming so in focus right now?
Well, I think to answer your last question, they're so in focus right now because the success of businesses now has a dual definition. You still have to deliver profits, but how you deliver profits is suddenly much more important. So let's focus on these two things I think are often confused, which is ESG and impact investing. So the simple way to think about ESG is whatever you do, just do it better. So if Microsoft announces that it's going to take its carbon footprint to negative over its entire history, that is an ESG move. Microsoft didn't somehow change the world broadly with its products, but it did what it did better. And around business, you all see it, this concept of how you're treating your employees. Are you bringing diversity into the workplace? Are you sustainable in your product roadmap? All of that is about doing whatever business we're doing better. Now, impact investing, which is where I spend most of my time, is, to my mind, the extra credit of ESG. So it's not just doing what you do better. It's essentially taking capital and identifying companies who, by their nature, by the products they develop and deliver, change the outcomes in society. So think of a solar developer, think of an ed tech company. Impact companies have collinearity. The more they grow, the more positive impact they have on society. The more Microsoft grows, the more work it has to do to solve its ESG problem. So this idea of a generation of companies, often formed from the beginning with purpose and profits aligned, is the backbone of impact investing.
So now here's my question, because profit is something that I would say it's easily measured, although certain companies try and kind of fuddle their way out of
yeah,
common
there's
profitability.
There's some creativity.
There's creative engineering there, creative accounting. But in terms of measuring impact on the world, in terms of measuring things that make a company a better participant in society,
right.
These things are really, really hard to actually measure. How do you kind of set the metrics so that you know that your portfolio companies are achieving their desired goals, your desired goals? And especially as we kind of look at what's going on in the business world right now, are there certain standards that CEOs can be looking at in order to make sure that they're achieving their goals on profitability as well as achieving these standards as well?
We're investors, we measure everything, and I sort of push back on this idea of you can't measure impact. So somehow we think we can measure very complicated concepts like risk, or we believe that we can actually measure Chinese GDP on a quarterly basis, and we get comfortable with that because we do it the best we can, and we do it consistently. And there's an opportunity in the impact world in a number of ways to really measure outcomes consistently in a way that will give us confidence that what we're doing is having positive impact. Probably the most simple area, of course, is carbon footprint, where there is good technology to measure your carbon footprint. But even in areas like educational outcomes, there is good research on how educational outcomes change based on certain practices and certain technologies, and we can measure that change. When we started the Rise Fund in 2016, this was a major issue for us, and it remains a major issue for the industry. There's a lack of confidence in the measurement of impact that I think is probably overplayed. If you look at the companies we're investing in, it's clear they're impact companies. And I would tell you that GAP, which is probably the #1 measurement system for business, took 70 years to develop. And even today, it's flawed. So the idea that we're going to have a perfect measurement system for impact, certainly I hope it comes. I'm going to support everything I can to develop it, but we shouldn't wait for it. We should find the companies that are clear and presently delivering impact and help them.
What are you working on right now toward that front? Is it customized per portfolio company? Would an online education company have certain metrics they need to meet, whereas a solar panel company have other metrics that they need to meet? Or how do you kind of square that? Because you have LPs as well.
The way we address this, because we can never be accused of greenwashing, we can never be convicted of it, because this is the core of what we're doing, that we're doing impact and profits together. So we actually created a separate public benefit corporation under our umbrella with a separate board and advisory group, which has Nobel laureates, university presidents, and they act like an editorial board. And every company we underwrite it financially, and that separate editorial board signs off on the impact. And we bring together at decision point those two underwriting standards. So I think we often get caught in the world of or, it's profits or impact. I think what we're trying to do is put together and. We can find companies that are and, profits and impact.
Scalability.
And scale. That's the other point I would add that is something that we're working on. There are many probably in the audience. There is a couple generations of really important impact investors, many of them individuals, many of them small venture funds. But when we joined the effort and really doubled down in it, we asked the question of why it had never scaled. The average impact fund in 2016 was $125 million. The biggest was 600. We raised $2 billion. And by going to a bigger level, we could take companies that had proven their concepts and scale them on a local, national or global basis. And this idea of taking ideas and scaling them is something that is absolutely critical for the future of impact investing.
Can you give us an example of how you do that? How you source investments, how you screen investments, how you scale investments, and then the potential for exiting those investments as well. Because we've seen it done time and time again in the traditional private equity model. There are many high-profile examples, but I think impact investing is different. It flies a little more under the radar. There isn't as much attention paid to the specific case studies, from beginning to end. So maybe you can kind of help us have a tangible sense of how you look at these companies on a more specific basis.
I think this is an important exercise because people tend to talk about these broad concepts of ESG and impact, and we're one of the first scale examples of what a portfolio of 40 of these companies look like. So I'm going to take it a bit farther, Leslie, and just really quickly speed date. Let's do 3 of them.
Great.
So Dreambox is a company that's an educational solution. It was built by a Microsoft engineer who had an autistic child and couldn't understand how he learned. So he built a math gamified learning system that watched how the child learned and evolved the next problem to that child's learning style. They then said maybe that works for everyone. So they created the first AI-enabled learning path dependent adaptive learning system. And it started as an individual product, and then a small venture fund bought it and started to move it to the schools. But the question of how you really scale it became critical. So we bought the company. We weren't the high bid, but we bought it because they believed that we would take care of it. And we put additional resource and development into it. We built the sales force. We took it from a K-5 product to a K-12 product. This product in the classroom, 1 hour a week, moves a child 60% farther in a given year. 1 hour a week. It's extraordinary. And the more children who use it, the better it gets. So we moved it from 1,500 school districts to now 3,200 school districts. We moved it from 2 million students to 5.5 million students recently. We've more than doubled the company, and it's now the darling or one of the darlings of the educational software system. So now we're trying to scale it beyond to international markets. We just moved it into ELA, English Language Arts, and taking this idea to a national and global level is scaling impact. Second example, very, very different, is one of the most interesting companies in India. 2 problems in India are low protein availability and small plot farmers not being able to get a subsistence living because they can't get their products to market. So Dodla Dairy, a company we found in India, basically was building a cold supply into the outer reaches of agriculture in India, so that small villages can bring their milk to the urban market effectively without the middlemen taking all the profit. And then we went into these small villages and we basically taught them veterinary, how did we finance the women who were going from 2 cows to 3 cows. And that company more than doubled over the few years that we owned it. We just took it public. It's in a 45 times oversubscribed IPO.
Wow. In India?
In India, in the midst of COVID. And then a third example, which is a technology example. I just love this company. A couple of Stanford engineers came up with Stanford Half Moon Bay-based engineers came up with this really cool drone technology. Fixed-wing drones, flies 100 kilometers an hour, can drop a 5-pound package at 100 kilometers an hour autonomously into a parking spot. That's like really cool, but what do you do with it? Yeah. Well, what they decided to do with it is they realized that in Rwanda, women in particular were dying in childbirth because they could not get the right blood to the 2,000 clinics around the country. So they set up 5 stations with blood around Rwanda. And today, the most effective supply chain for medical delivery, for blood delivery in the world is in Rwanda and Uganda, where a doctor can hit their phone, and within 15 or 20 minutes, any blood they need will be at the location. Wow. That company scaled in Africa. It now is moving to the US, working in North Carolina with Walmart, and it'll be one of the first drone delivery companies in the US. So these are companies that we discovered because we were out looking for them. That's the first job. We brought them resources to go from idea to scale, and now we're trying to push them out into the world.
So you were out looking for them. Are they found through your traditional deal channels, or are these kind of more creative, unique pipelines that you're tapping in order to source these opportunities? Because it also feels like it's very, very global what you're doing as well.
Yeah. Yes and yes. So first of all, we go to market in 5 sectors: climate, education, financial inclusion, ag and natural resources, and sort of tech solutions. And so we send people out looking for that. But there's an important piece to this, which is what we learned is that mission-driven entrepreneurs want mission-driven capital. So when we appeared on the scene with mission-driven capital, some of them found us. But more importantly, we got in the right neighborhood, asked the right question, and just got to work. There's no mystery to this. You just got to get to work.
It's grit.
Grit? There's a fair amount of that. Grit and initiative.
Well, speaking of entrepreneurship, you have done your fair share of entrepreneurship yourself, obviously founded TPG. Now you have kind of made a career pivot to focus more on the Rise Fund. I just wanted to kind of get in your head, what were you thinking? What drove you to make that change? Especially at the timing that you did.
Some of that's personal. I think, I grew up with Midwest values, and the question of trying to do the right thing has always been there. Not always achievable at the full level you want to, but always there. And coming out of the global financial crisis, I think we as a firm, and probably me individually, began to ask the question of how can we do more? And that began with ESG. So we have 250 companies in our portfolio. How do we just do what we do better? Let me give you an example of how that works. A few years ago, we realized that there was a lot of discussion about increasing board opportunities for women and diverse board members. We have a lot of boards. So we put together an effort, and in just over 2 years, we put 108 women onto boards. 30% of them diverse, because we could and because we should. And so that idea of taking the governance of private equity and just making stuff happen, the 2 words that guide in this are it has to be authentic and it has to be action. There's a lot of discussion, but if you get authenticity and action, things happen. And then after we began to get better on ESG, and got our own house in order because we're in an embarrassingly white and male industry, so we had a lot of work to do there. We asked this question of why impact had never scaled. And for me personally, you get to a point in life where you want to say, what can you do personally? And one of the things I can do is accelerate capital to these issues. And the scale of what's needed, most of you are probably familiar with the UN Sustainable Development Goals, really a aspiration from the UN of what we need to do to change the world. If you take all the government money, all the philanthropic money, all the NGO money, and add it up, it's $3.9 trillion a year short of what they need. The only place that money can come from is if we ignite private capital. And that money will not come for concessionary returns. We have to create opportunities to drive profits and prosperity together.
Let's talk about concessionary returns, because that's an interesting concept, and I think one that will surprise a lot of people. This idea that impact investing historically has been one in which people were like, okay, sure, we'll accept lower returns because we feel like we're making an impact, we're doing something good. Why was that the case, and why do you believe that needs to change?
So first of all, I admire all the people who've come before me in this pursuit, and much of the best work has been done in the philanthropic areas and should continue to be done in philanthropic areas. But when impact investing started, it started with the idea of if you do good, you should be willing to take a lower return. And I continue to support that idea, but we have to realize that there is a very limited amount of concessionary capital available.
Wonder that didn't scale.
It didn't. I mean, it's a great idea, but all of the huge pools of capital that I work with, they have their own fiduciary duties. They are not allowed to make that trade-off. If they really want to bring billions of dollars to this problem, they need to believe that they are going to at least achieve market returns. And one of the kind of paradoxes, and as investors, you're constantly looking for what's different than people expect. And when that expectation was in the market, we went back and looked at the entire history of investing we did. We picked out the deals that would have been impact deals, and they had higher returns than the average. So the idea that this need be concessionary was potentially flawed. So when we went to market with Rise, we said this is an and fund. We are going to deliver impact, and we can talk about how much we've delivered in a moment, but we're also going to deliver market returns. And the fact that we've done Rise 1, Rise 2, we're now raising Rise Climate, tells you that our LPs are seeing that. And if you look publicly, you can find on our Rise 1 portfolio, we've already had 4 IPOs, many multiples of what we put into those deals. So you can do this. It's harder. And it's why you need to get some of the most experienced firms in the world working on it.
Why is it harder?
It's harder because it's and. You know, if you're only solving for one vector, it's always a little easier. But
is it harder than traditional private equity, do you think?
It's more work intensive because, for example, you look at one of our companies and I look at a report, I get twice as many pages. I get the same financial package and I get a page on how are we doing versus our impact underwriting. Are we serving as many students as we thought? Is 100,000 zipline deliveries enough? So it's harder because it's more work, but I'll tell you, it's more satisfying too. And the entrepreneurs that we work with, this is an extraordinary generation. They are beginning these companies caring deeply about what they're doing. And in some ways, I think those companies are a snapshot of the future. And the fact that they exist tells you that we can build a future where business is an and proposition.
Now, on kind of that same idea of returns, oftentimes when you see kind of a crowding effect or an increased popularity in a certain area, capital flows there, and you see a revaluation take place where it suddenly becomes a lot more difficult to achieve the returns that you initially set out to achieve. Are you experiencing that now with that sea change that we spoke about earlier, this kind of mindset shift that people are having? Is that requiring you to pay up for some of these assets?
Well, first of all, Leslie, for you or anyone in the room, if you can find an area of investment where there's not enough money, please let me know. Like, call me right now. So there's competition everywhere. But relative, so for example, we're raising this climate fund. It'll be substantially larger than $1 billion. There are 193 private equity funds in the world greater than $1 billion focused on technology. I think we'll be number 2 on climate. And yet, climate is going to take $150 trillion over the next 30 years. So yes, there's interest, but it's still underserved in my view. And the second thing, I love to see Tesla's stock price, and I love the fact that ESG ETFs are among the most popular in the market, because if we build this next generation of impact companies, the market is waiting for them. They're looking for it. So this is the beginning of a long-term trend, and I'm not concerned that there's too much money. For the problems and opportunities we have, there's not enough.
So you brought up the climate fund, which I'm surprised to hear is actually only the second out there. What do you plan to do with that, and how does a private capital climate fund interact with the public sector to achieve these desired goals? I saw that you had Hank Paulson kind of spearheading this at the request of Bono. So
one of the things you find is when you travel, you want to have interesting people to travel with you. When we set up the Rise Fund, we set it up in partnership with Bono and Jeff Skull. When we set up the Rise Climate Fund, we set it up in partnership with Hank Paulson, who's someone who lived at the intersection of capital and crisis and business at a different crisis, and is kind of re-emerging to help at this moment of crisis. And it's been a great opportunity to work with him on this. And so the climate, first of all, let's talk about climate generally and then where we sit. In my investment career, there's been, I think, this will be my 4th great cycle. The first cycle was the interest rate super cycle. Interest rates went from 15 to 0. Great time to own assets. Second cycle was globalization. Supply chains and businesses went around the world. Third cycle was really technology. And the technology cycle is most like what we're about to see in climate. It affected every business. It affected all parts of life. It's a 30-year cycle. And one of the things that was really important in that cycle was the presence of specialized pools of capital that supported it. The venture capital industry in this country had a major role to play in helping to bring capital to those new ideas. So today we sit in the climate area, and there's a robust venture market. So there are multi-$100 million venture funds, and there's a robust market for contracted renewables. Pretty easy to finance a solar farm today if someone will give you a 15-year contract. But who's creating the Teslas of tomorrow? Who's creating the next wave of climate companies? And that's really a private equity activity in the private markets, and that's where we're focused. And I have to tell you, it's among the most interesting investment landscape I've ever seen. There is no silver bullet, it's silver buckshot. It has to be everything from how the grid works to how we make cement to how we make plastic to
batteries.
How we deliver things to batteries. And it's immensely complex, and that complexity gives advantage to focus by things like the pool that we're building.
Now, if I'm understanding your analogy correctly, the tech cycle saw its fair share of ups and downs and then ups again. Are you expecting the same to take place with climate?
Oh, of course, of course.
And we can kind of see this taking place right now in the public markets and SPACs and a bunch of different companies. They just have the word electric vehicle, and it's like,
yeah, well, let me give you just a moment, those of you, and if I look at this crowd, you were there for this. This is tech 1998. There was a period of time where it was just getting onto people's radar that this is going to be big. And at the moment, it was AOL, and it was a series of companies that jumped to the public market way too early. If you remember, Amazon went public in about 2 years. After the financial markets set themselves up, Uber and Airbnb stayed private for 10 to 12 years. Mm-hmm. So we're at this early day where capital is trying to solve this issue. And one of my engineering professors told me once that technology never moves in a straight line, and this is true. We put men on the moon before we put wheels on suitcases. So look it up. Wheels went on suitcases in 1972. Like, how did we not think about that before? So we're in the early days of what is going to be an extraordinarily complicated evolution of the market. But I'm optimistic. Something you and I talked about on the way in. There was a sense that all this green impact, ESG, that was an upmarket phenomena. That as soon as things turned down, that would the iceberg would melt. And think about where we are today. We just went through a global pandemic. We've gone through immense social upheaval. And coming out of that, I think we've moved from discussion, the what and why of climate, to the how and now. And it's picked up speed. Social investing has picked up speed. And one of the real surprises for me is the companies that we've been building, they did better than we expected. They actually doubled down. If you have profit and purpose, and for a moment in time you lose profit, the purpose is still there. And these companies were extraordinarily resilient through the cycle.
Why do you think it is that the pandemic kind of initiated a call to action on climate? I mean, I guess the two are sort of related, but not in a straight line.
A few. I don't have a great answer, but a few things on my mind. First of all, maybe we realize that nature can get pissed off, and that there's times that if we really piss it off, we're going to pay for it, and that became clear, and it became clear fast. The second thing is there's times when we have to act collectively. And it's fascinating, if you think of a couple things that did work during the pandemic, like Operation Warp Speed worked. Money went to business and government worked on a problem together. Vaccines worked when they went to CVS and Walmart and Walgreens. So this idea of We got to act. We got to act collectively, and business has a role in it. I think maybe actually picked up steam in a time people thought it would slow down.
So this is my last question, and then I'm going to take questions from the audience and those of you who are viewing online. But I'm curious, does all of this have staying power? Right now, we are in a period in our business cycle that it's profitable, valuations are high. It's maybe easier to pay attention to the way to run our business better. If the market turns and companies are distressed and more in kind of a crisis mode, does this all go away? Or does it get accentuated, kind of to your point about your portfolio companies during the pandemic?
It's hard to say for sure, but I don't see it going back. Let's take just climate for a second. What took off was really 4 forces that hit at once. So, as I said, 1,600 CEOs said they were going to be net zero. We have the Greta effect, which consumers suddenly want green. You can get the carbon footprint of your Allbirds, you can hit Uber Green for just a little bit more, and people are hitting it. Then there's what I call the Larry Fink effect, which is investors everywhere say, we care. And if you want to get companies' attention, get their investors' attention. And the last thing, and this is something that people miss, and all 4 of these were hitting at once, the technology shifted. EVs, wind power, solar power is now totally cost competitive without government subsidies. So I think when it tends to retreat is when we're counting on government action, which kind of goes in and out of the market. But at least for me, these feel like trends that aren't going back. And that feels like a source of optimism to me.
On that optimistic note, I think we should take questions from the audience. I think we have one right over there.
Hi, thank you very much for an incredible presentation. As a fiduciary, the private equity investor with the fiduciary for the highest returns, when did you pivot or evolve into impact investing? And did Ed Bass have any effect on your thinking? He was like wasn't he like the original impact investor back when no one even thought what it was? And then second, where do you think about investing in real estate for net zero? And will all buildings be net zero, and if so, when?
So first of all, on the Ed Bass question, for those of you who don't know my background, I actually started working for a family investment operation, the Bass family. And if you look at the pioneers and people I have immense respect for in the impact investing world, were almost all individual investors. And you see, for example, Lorene Jobs today, Richard Branson does a lot, Reid Hoffman, Pierre Midyar, Jeff Skoll. And in some ways, on the shoulders of those giants, we're trying to build the institutional market into it to really accelerate beyond. So I'd say yes, my experience with family investors actually gave rise to Rise, in part. The other thing that's really interesting is as we talk to our investors, some of the most fascinating discussions we have are families that have invested with us, because it becomes a multi-generational way of coming together. I'm sorry, your second question was net zero buildings. The real estate marketplace will certainly be under intense net zero pressure. And to really get to net zero, you probably have to build to that. But there is very substantial retrofitting. I'll tell you one of our interests. Here's another Rise company. The founder of it is a young woman who was just on the cover of Time magazine. It's called Grow Intelligence. And she built a massive climate database. And so if you're an asset owner, if you give her the addresses of all your buildings, she can draw a climate curve and tell you which of your buildings are going to be climate impacted first. And that database will be a very interesting way to help solve this problem, because we not only need to make all our buildings net zero, but we need to begin moving now, and where do you start?
Interesting. I'm going to take one of the questions from our digital viewers. How can normal people without significant investment portfolios put their money to work with impact investments?
Know that as every time an investor decides to put that into their calculus, you're helping the cause. So there will be increasing disclosure on what companies do in terms of carbon footprint. But with each transaction, with each investment you make, you're signaling to the market. So it's hard as a small investor to have access to private equity, but there are good products in the public market. And importantly, your behavior is the #1 way to send the message.
That's great. Where are we going? Yes, right here.
I work with an angel investing organization that focuses on women-led founders on the premise that they can do really well or better than male-led companies, but also because their access to capital is just pitifully poor, I guess, as you probably know. From your perspective, what's it take to change that, and what seems to be the hurdle, I guess?
It takes intent and it takes action. So I agree with you. One of the real problems in our industry is that we don't have diversity in the chairs of capital allocators. And that then makes it harder to get diversity down in some ways to diverse entrepreneurs. So if we can begin focusing on it, it's exactly what I said about impact companies. It's grit and focus on it. Something that we recently launched that you may have seen is called TPG Next. And as TPG, we have backed, I think we just assigned our 4th investment firm that we're putting money into, all of whom have diverse investors, all of whom are focused on diverse founders. And that idea of building a cascade, this will take a decade, but we're already moving the needle. And so I very much applaud what you're doing. If we begin to focus on the problem, direct capital against that focus, it'll happen.
Back there.
Thank you. Greg Hammer from Miami, and I represent Business Climate Leaders. We're an organization that represents the business community and helps them bring the voice to Congress in support of bold climate policy. You mentioned Hank Paulson, James Baker, and Secretary George Shultz, a Republican icon who died at 100 earlier this year, was on our board in advocating for a price on carbon. And I haven't heard you talk about that, but most experts across the board, left, right, center, from industry leaders, even oil and gas giants, agree that nothing would accelerate the shift of capital. It's all about shifting capital. You talk about scaling solutions, shifting capital. Nothing would shift capital faster than a price on carbon to give the investment community the incentive to redirect capital away from dirty energy and reinvest in clean energy and low carbon solutions and many of the other solutions that we have before us but fail to scale for that one reason. Can you please speak to the need for that? And that's what we do, but I'd like to hear you educate the rest of the people in the room. And I'm here to give people the opportunity, companies as well, in bringing the voice to Congress.
Yeah, I am supportive of a price on carbon because externalities should be priced, and carbon is clearly an important externality. I'm not the leading policy voice on that, and my reason for that is I feel a little bit like that, like I do about universal health care. I believe in it, but I'm not going to make it happen. But while it's happening, we just built a new hospital in Lagos, Nigeria, and another one in Bangladesh. So while the discussion is going on, while we support that discussion, let's take action. And so how are we taking action? We own the largest independent creator of carbon credits, which is a marketplace that can begin to bridge. Is it as good as a price of carbon? No. Is it a step? We can debate that, but it's working today to begin to get change happening. So the policies, I hope, will develop, but I think it's also important that while we're supporting their development, we take action.
Speaking of the flow of capital, a question from one of our viewers online is, how can I send my money to the Rise Fund? You must have made a good pitch.
Well, one of the things, just as an aside, we've said at Rise we have a triple bottom line. So we're going to deliver returns, we want to deliver impact, but we also want to open this market up. And since we launched Rise, there's been, I think, 4 or 5 other major private equity firms that have followed into the market, and we support that. And in our future fundraising, we're going to try to do more in the individual marketplace. We traditionally raise because I really believe in getting the money flowing. If we can get the money
Does that mean
flowing.
like an ETF? Like a
Just placements through
retail platforms?
retail placements. And we traditionally have not been large players in that market, but I think there could be a strong appetite.
All right. I think we have time for maybe one more question right here.
Oh, good. It was me. Woohoo! I won. This is Beth Ann Bovino from S&P Global, and I also do research. Something that you said on Dreambox, I think it was, and you talked about the scaling of Dreambox to many school districts in the United States, I believe just in the U.S. at this point. My question, I had two questions, as everybody does. First question is, are you looking at, are you scaling it to school districts where there are children who are underrepresented, meaning lower income communities, for example, communities of color, and that's the first question. So are you looking at that? And second, it seems like this is a very successful project. Are you tracking it with data? You mentioned that measurement is, of course, depends on data, and so I was wondering if you're tracking that as well. Privacy issues, of course, controlled.
Yes, we are expanding nationally with a focus on diverse districts, but probably one of the things I'm proudest of is when COVID hit, we gave the product away for free for a year. So we built into districts that might have had budget issues where essentially we introduced the product in and got it into the classroom for a period of time in order to expand it because we knew that we needed educational solutions. From that, where people will decide whether or not they want to essentially put it in the budget over time, but that's been a very effective way to increase access. Not enough access yet. We know that the connectivity of the schools are still a problem, but I think good strides are being made. On measurement, absolutely. So we have Y Analytics, our measurement group, reports quarterly on how many students, efficacy, sales, so the idea of impact. We underwrite deals such that they're measured on the multiple of impact per dollar we invest, and we track that quarterly.
All right. Well, we wish you the best of luck on your impact fund, on your climate fund. Thank you so much for sharing all your words of wisdom and insight with us. Jim Coulter, appreciate it.